Hello and welcome to this June 24th, 2010 video version of InvestEd Central's Chart of the Day. I'm Tom Boley, InvestEd Central's Chief Market Strategist, and it's my pleasure to provide you with today's Chart of the Day. This Chart of the Day is brought to you by StockCharts.com, simply the web's best financial charts. Well, today we are featuring something a little different, taking a look at the 10-year Treasury yield. This is pretty interesting because if you look back over time, the 10-year Treasury has really been moving almost in concert with the S&P 500. We didn't go back and show that the Treasury yield had actually bottomed back at the end of 2008, but it did, and it started moving up here before the S&P 500. So it was a little bit of a leading indicator for equities. So as the 10-year Treasury rose in March when the S&P 500 bottomed, then you can see that they actually, the S&P 500 kind of made a catch-up, and the two rose together. Actually, the 10-year Treasury kind of went sideways while the S&P 500 continued to move higher and catch up, and then they both started moving back down together. What's interesting here, though, is that the 10-year Treasury now, if you look at the actual 10-year Treasury up here, you'll see that we're about to break down, or potentially could break down. We really need to keep a close eye on this 310 support area, 310 on the yield. So let's watch and see if we break down. If we break down to the downside, then I think we could see some additional weakness in equities. So this could be, once again, a leading indicator. Let's be careful. The one thing that I do like about it is that with the lower low that we're seeing in the yield with the close on Wednesday, we clearly have a lower yield, but we have a much higher moving average convergence divergence. So if this long-term positive divergence kicks in and we do see a continuing rally here in the, or not a continuing rally, but if we see a reversal and a rally in the yield on the 10-year Treasury, that will likely stop some of the bleeding that we're seeing in the S&P 500 and that we've seen the last few days. If you want to see another look at this chart, you can check out the marketFORWARD section at investedcentral.com. In the newsletter, click on the marketFORWARD section, and there's a chart that shows you kind of an overlay of the 10-year Treasury yield and the S&P 500. I think it's very interesting, so you may go back and review that. But the reason that this works the way it does is because when money is flowing into bonds, in other words, bond prices are moving higher, that sends the yield lower, because the bond price and the yield move inversely to one another. So what happens is if money is flowing into bonds, that's normally a sign of a potentially a weak economy where folks are expecting lower interest rates. Also, the thing I think that's interesting to keep in mind is that when folks become very fearful in the stock market, they take their money out of stocks and they'll put it into bonds. So another reason for the yield to drop is because bonds are going up because investors are becoming more fearful. So it makes sense that as the yields go down, that we might actually see some additional selling in equities. So that's something to keep an eye on here as we move through the next couple of days, because if we do continue moving lower on this Treasury yield and break below, say, the 305, 310, 315 area, we finished on Wednesday at 311.5. If we move much lower than this, I think what this is telling us is that the economy is really going to struggle later in the year, and that potentially you're going to see some much lower prices on in the equity markets. I hope you've enjoyed our presentation today. Be sure to check out our chart of the day every day at investedcentral.com. While you're there, sign up for our free weekly Market Pulse newsletter and have the chart of the day emailed directly to you. Happy trading.